In the impact-first investing space, we hear this question all the time. The money is there, the intent is there, so why didn't the deal move? With over $100 million deployed into impact-first initiatives, we at Impact Charitable have seen and remedied for the most common patterns we see over and over again. These patterns show up across sectors, across institutions, and across good intentions. But before we go further, we want to ground ourselves in definitions in a shared field framework. Let's start with catalytic capital. Debt, equity, guarantees, and other investments that accept disproportionate risk and/or concessionary returns relative to a conventional investment. This is in order to generate positive impact and enable third-party investment that would otherwise not be possible. It's capital that is intentionally structured to absorb more risk, accept appropriate or slower returns, or offer flexible terms, specifically to unlock something that otherwise would not move. This is impact. Now, zooming out, impact capital more broadly refers to capital deployed with the intention to generate positive social or environmental outcomes alongside financial considerations. Catalytic capital sits within that broader category, but it carries a specific structural purpose. And here's why that distinction matters. When we blur intent and structure, capital gets misapplied. When we call something impact capital, but structure it like conventional capital, deals stall. Not because funders don't care, but because the design does not match the need. When the language around structure and the design are misaligned, capital gets stuck. That's where intermediaries like IC come in. We fill those structural gaps. So what does that look like in practice? Across sectors and institutions, the pattern we see is people saying it's just too complicated. The opportunity is strong and the mission alignment is there, but the structure itself feels overwhelming to build or to navigate. Most teams are already operating at capacity. So when a new vehicle, new structure, or new capital pathway shows up, it feels like one more thing to learn, one more process to take on, one more approval chain, and complexity, or even the perception of complexity, becomes the stalling point. Because when something feels complicated, we delay, pushing goals out to the next quarter, the next board cycle, after this funding round. So capital often moves on quarterly or annual timelines, but communities do not. That gap between institutional pace and lived pace is where strong opportunities are weakened and capital gets stuck. Take renter wealth building. For years, the idea that renters could build equity through public infrastructure felt unrealistic. It's too cross-sector, it was too new, it was too complex. But Colorado became the first state in the nation to launch a publicly funded renter rewards and wealth program. That didn't happen because the problem became simple. It happened because the structure was worked through. Nonprofits piloted projects, philanthropy participated, markets aligned, and we had public leadership. Multiple sectors aligning around one outcome: greater financial stability for renters. What looked too complicated was actually underdeveloped infrastructure. And once the infrastructure was clarified, the path moved. In the words of our partner, Santosh Ramdas, CEO of Gary Community Ventures, this is kind of a big deal. It gives renters a fair shot at participating in the economic upside from real assets and provides them a much-needed financial cushion. Again, most stalled deals do not fail because the idea is wrong. They stall because the connective tissue has yet to be built. The second pattern is a little more subtle, and it often comes phrased as, it's too risky. Often what is labeled as risky is actually just unfamiliar. For example, when you approach a tool like a program-related investment, for the first time, it can feel risky. Not because it carries more inherent danger than a grant, but because it's a different tool than people are used to using. Here's something we don't say enough. We have been utilizing grants as a tool for so long that we have forgotten or internalized the inherent risks of making grants. Simply because we have used a tool for a long time doesn't mean that the risks have changed. It just means that our perception of those risks have now aligned with real-world data, experience, and practice. To be clear, moving money of any kind carries risk. But when you equally consider risk, impact, and return, you can create a new calculation. Risk frameworks were largely built for traditional markets that are focused on financial returns alone. Rodney Foxworth, whom I have credited with this statement for years, is the co-founder and CEO of Worthmore. And he said, risk is code for bias. And history is riddled with examples of risk as code for bias in action. For example, redlining was justified as risk management. It excluded entire communities from capital access for generations. Avoiding perceived risk can create real harm. There is no impact without some level of risk. New solutions require new structures and the willingness to understand and accept risk differently. The next time you hear yourself or someone else say, "It's too risky," we'd like you to stop and ask, risky for whom and why? Traditional routes feel permanent, but they aren't. Let's ground this in another real-world example. Before 1974, women often could not access credit without a male cosigner. The Equal Credit Opportunity Act changed that. And yet, even after the law shifted, the Women's Bank in Denver opened in 1978 because traditional systems were still not serving women equitably. Structures that feel immovable can be redesigned. Just because something exists does not mean it can't be changed. We built this system of capital and finance, so we must believe in our ability to rebuild. We can create a system that is more just and more aligned with today's realities. Now, we must also consider the scale of what is coming. Over the next 2 decades, an estimated $124 trillion with a T dollars will change hands. This is happening globally in what is widely referred to as the Great Wealth Transfer, and it's a matter of fact that it's already underway. Women are expected to inherit nearly 70% of that wealth, with a JP Morgan study showing that 63% of women aged 60 and older have already received an inheritance. The anchors, which are the mental starting points that shape what we decide is normal, risky, or reasonable, especially in capital and investing, are beginning to shift. I hope you'll check out our LinkedIn, where our executive director, Rich Hoops, wrote an article just on the impacts of these mental anchors and why our old assumptions about risk, return, and structure can keep important deals from moving, even when everyone wants the same outcome. And while we're on the subject of anchors, here's something else we often say. Your network is your net worth. I first heard this at a conference in Minnesota with the Connect Up Institute, and it has stuck with me ever since then. Because when anchors shift, our gravity shifts. And suddenly the question isn't just what assets you control, it's who you're connected to, who you can call, who you can convene, who trusts you, who shares your vision. So when you're thinking about whether to reach out, whether to float the idea, ask the question, explore the structure, tool, or partnership, now is your time. Now is the time to give your vision the realest possibility to grow. If you are waiting for a signal, this is it. Let's question our anchors. Interrogate the assumptions that tell us this won't work. Let's reach out to our networks. Let's build new pathways instead of defaulting to inherited ones. We'd like to leave you with this important note. There is a structural reason that patterns persist. Expertise is siloed. Funders are often expected to navigate tools they were never trained to use. No one owns the connective tissue between intent and execution. And the reality is that most stalled deals don't fail because of strategy. They fail because the infrastructure between intent and execution is missing. Building new capital pathways costs more upfront. Intermediary infrastructure costs more upfront. That's the reality. A recent study from the Miller Center for Global Impact, the true cost of impact-first investing, shows that impact-first funds often have a higher cost per dollar deployed, not because of inefficiency, but because we're doing the harder, more inclusive work that traditional capital overlooks by design. And if capital keeps getting stuck in the same ways, that is not a coincidence. It's a signal. Here at IC, we see signals as invitations to redesign, with long-term and catalytic impact factored into strategy and structure. When we evaluate partners and deals, we ask, what is the impact of not figuring this out, of not filling this gap, of not helping this project scale on communities, on systems, on our shared mission of expanding access to ownership, stability, and generational wealth, and shifting capital and decision-making toward communities. Because sometimes the greatest risk is what we withhold. And if we keep seeing the same friction points, complexity, perceived risk, inherited structures, then maybe the work is not to push harder within the system. Maybe the work is to redesign it. And that's the invitation we're sharing. If this conversation resonates, follow or subscribe to Impact Perspectives with IC on LinkedIn. We'll continue unpacking the tools, structures, and strategies that help capital move with clarity and purpose. We're also looking forward to inviting some of our favorite partners to join us and talk candidly about catalytic capital in practice, what worked, what didn't, and what it actually takes to move more money in more ways to more people and places. $100 million deployed across 19 distinct pathways that were designed to help capital move. Because catalytic capital is not just a concept, it's structure, discipline, and design. And when it works, it changes outcomes for all of us. See you in episode 2.